Well, it's a good way to segue to our next guest. Ares, the large private credit company, a lot of other things going on, alternative asset manager, out with its second quarter results this morning. It topped $377 billion in assets under management, fundraising commitments at $17 billion. Private credit continued to be a dominant area of importance. Joining us now in a CNBC exclusive is Mike Arougheti. He's the president and CEO of Ares. It's good to have you and have you
It's
here.
good to be here.
After the quarter as well. $17 billion. I mean, can that kind of money continue to flow in? Obviously, it's the engine for so much of the fees that then are the profits that you see.
Yeah, look, we've been out with guidance that says that the company expects to achieve $500 billion by the end of 2025. And also articulated coming into this year, just given the setup for some of our large flagship funds, that we expected a very strong fundraising year. So not surprisingly, seeing $30 billion in the first 6 months is in line with expectation.
There is this sense that things are going to get overheated in your market, in terms of private credit in particular. And a question as to whether underwriting standards will decline as everybody competes. Because there's a lot of money, obviously, chasing this market. How do you respond to those who worry about that?
I think it's a little bit of a false narrative, to be honest. I think you have to think about private credit in terms of other markets. So if you look at the private credit market, it's grown about 15% per year for the last 10 years. That's squarely in line with the growth in the private equity market. It's squarely in line with the growth in the loan and high yield market. It's a little bit faster growth in the public markets, but pretty much in line. So I think part of what's happening is it's a fairly new asset class for people. And so they're learning about it. And so the speed with which it's growing to some is shocking. But if you zoom out and contextualize it in terms of the growth of the economy and the markets that surround it, it makes a ton of sense.
Well, then how do you, I'm always curious. There's a race to underwrite, a race to deploy capital to some extent. How do you differentiate your underwriting standards from your competitors?
Well, I think you have to. A lot of the business that people are paying attention to, which is only a fraction of the global private credit market, is supporting private equity. And if you look at it through that lens, there's about $2 trillion of private equity dry powder in the market. There's about $300 billion of private credit dry powder. So order of magnitude, when someone buys a company with leveraged credit, they're going to borrow $2 for every dollar of equity. And right now, even with the rapid pace of fundraising in private credit dry powder is about 30% max of available PE. So there's still a supply-demand imbalance. In terms of Ares, we were one of the first into this market. We've obviously been a market leader, and we differentiate on scale. We differentiate on flexibility. We differentiate in terms of the number of people, the geographic footprint. So there's a lot of things that go into it. But interestingly, 70% of the credit that we extended this quarter was into the existing portfolio. So that's actually one of the ways that we differentiate in slow markets.
Right. I mean, slow markets being obviously there aren't that many leveraged buyouts to fund. What are your expectations there? I'm curious as to what you're seeing or hearing from the sponsors in terms of the remainder of this year and whether things may pick up.
I think people have been waiting to get to the end of the hiking cycle, and now that we're getting there, we're starting to see the pipeline build. So transaction activity in terms of deals logged across our platform was up 20% Q2 versus Q1. And we're seeing that shadow pipeline build. So I think as we get into Q3, Q4, the markets will thaw. A lot of the sell-side bankers that we talk to are seeing the same thing.
We heard Steve Leisman talking sort of broadly about macro. I mean, you've made the case, of course, that, the returns that you can get right now in terms of potentially double-digit on a relatively short-term basis, making an extremely strong asset class. How long do you see that continuing for?
It's quite attractive. Obviously, we're generating 12 to 15% rates of return on pretty plain vanilla credit assets. I think
Are they really plain vanilla?
They are
I mean,
plain vanilla.
It seems hard to imagine you can get 12 to 15% on something you'd call plain vanilla.
Well, half of that is base rate, and a big chunk of that is fees. So if you just look at spreads have been fairly consistent. It's really just the benefit of the underlying. So part of the reason people are so attracted to private credit right now is because you're capturing that short duration front end of the curve, floating rate. So it's been a big outperformer. But if you look at the performance of the asset class over time, it's been a consistent performer because it has a pretty durable excess spread, excess return relative to other instruments. So I also think there's a view that as rates come back down, you'll see a softening in demand for private credit. I don't expect that. I think that people have now come to appreciate the durability of that premium that we're able to generate.
You do. So it's here to stay. Now I ask you this question every time in terms of disintermediating the banks, and you always come back and say the banks are our partner. But I am curious as to sort of how you see things playing out, particularly after some of the disruption that occurred last spring when many banks learned, not the biggest, that deposits can disappear very quickly.
Yeah, I think, look,
you benefit from that?
We do. The banking market is going through a period of transition. I think the U.S. market is overbanked. We're seeing new regulation being proposed. We're seeing a digestion of the Basel framework. So all of that will obviously drive more capital into the private markets. But we do talk a lot, you and I, about partnering with the banks. And a good example is we just bought a $3.5 billion lender finance book from PacWest prior to their recently announced merger. That was a good trade for them. It was a good trade for our investors, and it was actually financed with a very reg cap friendly financing from another large bank. So that, to me, is the playbook of how private markets can support the banking sector as it goes through this transition. I think we'll see a lot more of that.
Something else I know that you guys, I think it was started during sort of COVID, but you have a relatively new sports-related fund.
Yeah, we do.
What are you doing there, and why is that seen as an opportunity? It feels like it's getting a little overheated as well, how much capital seems to be chasing teams or parts of teams.
It's actually one of the reasons why the fund exists. So if you go back pre-COVID, the way that sports assets were financed was largely high net worth capital, rich guys, rich people, and banks. And leagues had very stringent rules on how they can be financed, who can own, et cetera, et cetera. When COVID happened, it blew a hole in a lot of people's capital structures because people weren't going to the stadium. They couldn't go to live events. And so leagues and team owners started to get more creative about how to finance themselves. And that was our entry point. What we've seen now post-COVID is the market's healed. It's a non-correlated store of value that people are very attracted to. But there's only so many wealthy people that can attract,
You've got to find the next incredibly rich person to buy you out, because it's not based on the fundamentals of the underlying cash flow characteristics.
It's not cash flow, but value, right? And if you look at the asset class, it's grown pretty consistently 15% per year for the last 15 years. But the need for institutional capital in all of its forms, private credit, private equity, structured equity, media rights securitizations, to come in and support that growth, I think, is what's going on now.
And finally, sort of this idea of sort of the alternative private credit, or, ABS in that area. Is that a real opportunity for
I think that's going to be probably the fastest growing part of our private credit business and private credit in general. That's really at the nexus of this whole bank market transition. So if you look post-GFC, the securitization apparatus has largely been dismantled. A lot of those finance companies have found their way into the private market. They're now re-aggregating assets. And I think now, with this next wave of bank consolidation, bank simplification, and regulation, you'll see that alternative credit market start to come to the hands of the private market.
So that's a key area of focus for you.
100%.
All right. Mike, always good to get an update.
Great to
Thank
see
you.
you.
Good to see you, too. Mike Arougheti from Ares.